Joining us now is Ken Leon. He is Global Research Director at CFRA. Ken, thanks so much for joining us. Great to have you.
Great to be here.
So Ken, bank earnings season kicks off next week. We've seen this really impressive performance from the big banks since the April lows. What's next? What are you expecting to hear from some of these banking giants?
Well, that's true. And what a change from when they last reported in April, when there was tremendous uncertainty in the markets and the world and what that could be, which was mostly banks telling us of a cloudy outlook. Today, quite different in terms of where we are. We're expecting the banks to have more confidence, not only in reporting what we think will be strong second quarter results, but also the outlook for the second half of this year into next year. There's a lot of factors that go into that confidence that we have as well, which is especially an improvement in the capital markets. Also, the U.S. economy is not falling off the table. We're seeing economic growth, which is good both for loan growth and also less concern about moving out of the normal range in terms of credit risk or delinquencies.
Not as cloudy of an outlook, but still some uncertainty out there and stock prices that have run much higher. So how high is the bar, and which banks do you think will clear that bar?
Well, that's right. So at CFRA, we have an overweight on the financial sector. The banks are, of 6 of the top 10 constituents are the large global banks. What we've seen, and where I sit here looking at all the markets around the world, is increasing confidence about the capital markets. And here it started in Hong Kong with IPOs. We've seen some high profile IPOs here in the US. Additionally, we're beginning to see the pipeline come to market, and mergers and acquisitions, which has been really very quiet over the last 18 to 24 months. There's the beginning of M&A activity, not only corporates, but about 20-25% of those transactions are driven by private equity firms, which have $2 trillion of owned companies that need an exit ramp so they can finish old funds and do fundraise on new funds. That will be a big part of the story for M&A and investment banking over the next 2 years. To your question, which banks? We think the delta is those who are more exposed to the capital markets: Goldman Sachs, Morgan Stanley, even Citigroup. Less so maybe for the regional banks or Wells Fargo. We did downgrade maybe a couple weeks too early Bank of America from buy to hold. Also JP Morgan Chase probably should have waited. But those banks have two factors. One, more exposed to the general economy, to loans, and then also interest rates on net interest income. Just to be an analyst for a moment, those banks, the latter, 55-60% of their total revenue is net interest income. Morgan Stanley and Goldman Sachs, well under 20%. So again, I'm coming back to the capital markets. That's part of the bull case scenario for the second half of this year and confidence for next year. One other area or two that we should talk about is the Trump administration and public policy to open up regulation, then of course the Fed.
You're obviously turning more cautious then with the downgrade a few weeks ago on JP Morgan and Bank of America, as you said. You made the point it could be due to net interest income, but is that also maybe a red flag about the strength of the consumer as you think about the back half of this year?
Not really. I mean, these are still holds. We're not negative. It's more so, these stocks are up over 35%. The valuations are a little bit stretched. That being, on looking at price to book value, sometimes crossing 2 times. So overall, what I'm saying as an analyst is, how do we support current or future valuation? It's going to be earning those earnings, which again, I think there's more of an impact or contribution from the capital markets. Also, those banks, Goldman or Morgan Stanley, have superb leading franchises in asset management and wealth management, which give you durable recurring revenue and of course mark to market with elevated market prices here in the US and around the world, that's going to be great fee income for them and for the other banks.
Ken, do you think we'll get clarity in terms of outlook from the banks this time around?
I think we're going to get more confidence, and the likelihood is, guidance for this group is very paltry. There isn't much. There might be a guidance for total expenses for the year or net interest income, but I think overall what they're going to be saying is there's a lot of activity with clients. What they are seeing is the CEOs, CFOs being much more active of what they want to do on going to the public markets for their investments. Additionally, and Bank of America, Brian Moynihan, the CEO, is really great about talking about the consumer. I don't think there's any red lights there. I think mostly he's still going to be talking positive about the U.S. consumer, which is important for credit card and personal loans. So overall, again, there's just surprising normalcy, even though there's been tremendous stir of the trade tariffs and uncertainty, for sure.
I'm curious, just finally, do you think we'll hear a much different picture from the smaller regional banks than we'll hear from the bigger banks?
So we look at all the banks, and my colleague, Alexander Yoakum, who covers it, is looking for the super regionals to be having outstanding results. And again, the concern would be two factors. Again, that metric called net interest income, you get there in two ways. Direction of rates, which right now, lower rates is not the best thing, but if the economy is strong, then you make it up on volume, loan volume, to get the higher net interest income and margins. I think those banks are going to be talking about that and also not taking any significant reserves, either for concerns about the consumer or, again, across all the banks, any black swan event that would hurt the banks and hurt, obviously, their share prices.
Ken Leon, CFRA, appreciate you getting us ready for bank earnings. Thanks so much.
Thank you.